Pass the necessary journal entries for the following transactions on the dissolution of a partnership firm of Vibha and Ajit after various assets other than cash and external liabilities have been transferred to the realization account. Now, before we begin, always remember that assets by default have a debit balance. To make them zero, you have to credit. So when you're transferring assets to the realization account, the journal entry is realization. Okay, realization debit to assets. Similarly, similarly, when you are transferring, when you're transferring liabilities by default, liabilities by default have a credit balance, right? And therefore, when you're transferring liabilities, what you're going to be doing is realization, and let's spell realization with an S, realization account is going to end up getting credited. Okay, why? Because the liabilities have a credit balance. To make it them zero, you have to debit. So liabilities liabilities will be debited to realization realization. Okay, most of the transactions will involve making this. Apart from that, we may have some expenses and losses. Okay, so now going forward, if there are any expenses and losses, we will debit realization, and we will credit probably the cash account because we'll be making payments. Anyway, let's look at our entries now. Creditors worth 46,000, accepted 9,000 cash, and furniture of 32,000 in full settlement of their claim. Now, what is important for us is only when there is movement of cash. Why? Because these creditors worth 46,000, okay, who are taking furniture, both of these items have already gone into the realization account. We don't have to bother about them. Okay, we are going to be putting them into the realization account. What we are only interested in is the cash component, and that is 9,000. 9,000 in cash is being paid. Okay, and we credit what goes out. Where is that going out from? The cash account. On what account is it going out? Because of the realization account. Something in the realization account is making cash go out. So we debit realization account. Okay, and let's see. It's in the books of Vibha and Ajit. Okay, journal entries in the books of Vibha and Ajit. And let's see, let's go a little further down. And we do not have dates. We do not have dates. Okay, but we have serial numbers. Right. And you can consider putting the serial numbers in the margin. Okay, you can consider putting serial numbers in the margin. Okay, and so the first entry that we have is going to be realization account debit to cash account. Realization account, realization account debit to cash account, only being what is paid in cash. All right, why are we not doing anything with the furniture and with the creditors? Because both of them are already in the realization account. So something in the realization account, which is creditors, is causing us to make this payment. So we debit the realization account. There are no longer any assets and liabilities left. The only asset that we have is cash. All the other assets are now part of realization. Anyway, being cash paid to creditors along with furniture, along with furniture in full settlement. Okay, so just write a narration which gives a summary about the transaction is, draw a line and we move forward. Okay, now we look at transaction 2. Okay, and please put them in the margin. Avoid putting it into the date column. All right, now we go back to our question. All right, and they're telling us that firm had a stock of 20,000. Ajit took over 40% of the stock at a discount of 10%, while the remaining stock was sold for 18,000. All right, so if the total stock is 20,000, if the total stock is 20,000 and Ajit took over 40% of that stock, that means he took it over for 8,000 minus the 10% discount. So if we were to take 20,000 and then multiply it into 40%, okay, 40%, we're going to get 8,000. 10% of that is 800. So as far as Ajit is concerned, he's taking 7,200. Ajit is a partner. We have partner's capital account. We can debit the receiver. Okay, apart from that, they're saying that the remaining stock was sold for 18,000. Okay, so Ajit will end up being 7,200. Cash will end up being 18,000. And the total amount we can credit the realization account. Why? Why not the stock account? Because we have already put the stock in the realization account. So something in the account is causing us uh, to receive money as well as charge a partner. All right, so it is going to be debit the receiver, debit what comes in, and credit what goes out as far as the stock is concerned in the realization account. All right, so our journal entry is going to be Ajit's capital account debit, Ajit's capital account debit. Okay, debit the receiver for 7,200. Then we have cash or bank account. Okay, since they've not been very specific, it could be either, so no problem. Cash bank account, up to you. Cash bank account debit. Okay, for the remaining 18,000. Okay, so debit the receiver, debit what comes in, and credit what goes out, which is the realization account. All right, for a total of 25,200. Okay, remember all of these journal entries, you can memorize them, no problem. Standard journal entries. Alternatively, just learn the golden rules. If you know the golden rules, life becomes very easy. Okay, and now we summarize the transaction. So it's going to be being 40% stock taken over by Ajit and the remaining stock sold for 18,000. Okay, so being 40% stock taken over by Ajit and the remaining sold for rupees 18,000. Now, remember the discount we don't get into because it remains within the realization account. The stock was put on the debit side of the realization account at full value, and then we're giving away a part of it to a partner at a discount. When we balance the realization account, automatically that profit or loss gets looked after. Okay, so we don't have to do a separate entry for it right now. Anyway, going back, we have Vibha was appointed to look after dissolution work for which she was allowed a remuneration of 16,000. Vibha agreed to bear the dissolution expenses. Actual dissolution expenses 15,000 were paid to Vibha. All right. And now, uh, as far as the firm is concerned, they are paying her 16,000. All right. What about the actual expenses being 15,000? Very good. She's putting in effort. She makes a gain of 1,000. That is not our concern. As far as we are concerned, how much are we compensating her? 16,000. All right. So going back to the journal entry, realization expenses. It's in the name. Expenses, debit all expenses and losses. All right. So first I will draw a line. Okay. Please draw straight lines with a scale. Realization account debit. Realization account debit. Okay, debit all expenses and losses for the full 16,000. Who's doing this for us? Who's handling it for us? Vibha. Okay, so to Vibha's capital account. So debit all expenses and losses and credit the giver. Okay, so being okay, and I'm going to purposely go back to the transaction and see what this is about. Okay, being dissolution remuneration allowed to be. Okay, so being remuneration of managing dissolution dissolution, and as far as possible stick to the wordings that you have over here. Okay, so dissolution work, managing dissolution work. Okay, and next we can go to 4, right? We draw a line. Now, Ajit's loan of 45,000 was settled at 42,000. Ajit has given a loan to the partnership firm. This loan is going to have a credit balance. Okay, and under normal circumstances, all right, it gets paid in full. Alternatively, it could be a partial payment and the remaining amount gets transferred to the realization account. Or if the partner is taking some of the other asset, furniture, or property, or whatever, okay, then as it is, we pick up the whole loan, which is a liability, and put it in the realization account, just like we do with all the other external liabilities. Remember, just because Ajit is a partner, all right, I'm going up. Yeah, Ajit is a partner in the firm. He's given a loan. But remember, dual entity, the business and the business person are separate. When the partner is giving a loan, it is just like any outsider is given a loan. All right. Now, we are paying 42,000. Okay. And that is going to be cash or bank. And that money is going out. So we credit what goes out. All right. So Ajit's loan has a credit balance of 45,000. It is settled, means it becomes zero. So that means we have to debit the loan account by full 45,000. We can credit cash or bank account only with 42,000. And the difference will go to realization. Okay, and it's a gain for the firm because they're paying that much less. All right, so one more time. We have Ajit's loan account, Ajit's Ajit's loan account, which has a credit balance. We want to make it zero, therefore we debit. Okay, we credit cash or bank because we credit what goes out. Okay, cash or bank account, and we credit all incomes and gains to realization account because that much we do not have to pay. All right. And we have 45,000, which was the full value of the loan. It was settled for 42,000, and the difference is your gain of 3,000. Okay, so being Ajit's loan settled, being Ajit's Ajit's loan settled, right? And once we're done with that, again we can draw a line. And moving forward, we have a machine which was not recorded in the books was taken over by Vibha at 23,000, whereas its expected value is 28,000. Okay, and now remember, it wasn't in the books. That means it was never really transferred to the realization account. It was not in the balance sheet. It doesn't get transferred to the realization account. But Vibha is taking it over for 23,000. Its value was expected to be 28, but it doesn't matter. Neither are we transferring it, neither do we have to calculate that profit or loss. Frankly, something you didn't know, existed is now there. It's good for you. We will credit the realization account and we will debit Vibha for the value at which she takes it over. So debit the receiver, right? We are now on transaction five. We're now on transaction five. Vibha's capital account, capital account debit, okay, by the value at which she's taking it over, 23,000 to realization account. You didn't know something existed, it is there, you're making some money. Okay, so it's a gain for you. So you can think of this as credit all incomes and gains. Okay, it's an unrecorded asset. If it was a recorded asset and you were putting it in the realization account and then you're selling it or a partner's taking it over, you will credit realization account. That would be credit what goes out. Anyway, either way, we credit realization account. Okay, and being unrecorded asset, unrecorded, unrecorded asset taken over by Vibha. Now, we have a transaction six. Let's see how many are left. Okay, that's the last one. The firm had a debit balance of 20,000 in the profit and loss account on the date of dissolution. We have two partners, Vibha and Ajit. They have not told us anything. So we have to assume that their profit sharing ratio, okay, profit sharing ratio is going to be 1:1. If you have a debit balance in the profit and loss account, we want to make it zero. We will have to credit. Okay, so we are going to end up crediting the profit and loss account and debiting the partners in their ratio, assumed ratio of 1:1. So 10,000, 10,000. All right, so we have got two partners, Vibha and Ajit. So it will be Vibha's, Vibha's capital account debit, Ajit's, Ajit's capital account debit, 10,000, 10,000. Okay, and we will credit the profit and loss, credit the profit and loss account by 20,000. Okay, and being whatever is in the entry. So being debit balance in profit and loss debited. Okay, we are debiting the partner's capital account. So being debit balance, or you can say transfer if you want, debit balance in profit and loss account, profit and loss account transferred. Transferred to partners capital account. Alright, narrations are important. I know it slows down the video, but it is something that needs to be done. Okay, any doubts, feel free to ask. And as always, please like, share, and subscribe. Thank you.